The United States of America was founded by rugged individualists pursuing their rational self-interest. Underpinning that concept was vicious and sometimes very aggressive entrepreneurship. In this study, we're going to talk about entrepreneurship, and the concept of the startup over time. In order to tell that story, we selected a special vintage, the vintage that started business in 2010. Those were the small businesses that had the guts and the courage to start their business right at the cusp, right at the end of the recession of 2008 and 2009. And we selected that special vintage to see how they were behaving over the last 4 years between 2010 and 2014. In this particular slide, we show the Small Business Credit Index. That is an index created by Experian with our partnership with Moody's to talk about the overall health of the business climate, small business climate in the United States. As you can see from this graph, it was at a very, very low point back in 2010. So we knew that business conditions at that time were struggling, and we wanted to see how those courageous entrepreneurs were behaving between 2010 to 2014, and that's why we selected the 2010 vintage. We took a random sample of approximately 1 million startups, those that started between 2010 and 2014. And what we saw was that there had been a decline in startups from 2010 all the way through the 2014 vintage. There are many reasons why that was occurring, mostly which it's not uncommon that a lot of businesses start up after economic downturns because maybe the entrepreneur got laid off and maybe they were saying, hey, maybe this is a good opportunity for me to start my business. And then over time, that tends to tail off as the economy was picking up. A lot more went back into the workplace, and a lot of businesses were not being started because the economy was actually improving. So where were those startups concentrated in terms of industry? So what we did is we looked at the industry based on the SIC code here at Experian's database, and we found that the majority of the startups were occurring in wholesale businesses. Wholesale businesses, those are ones that were perhaps third-party businesses, so those that are in the middle, the middleman, if you will. So if you were a wholesaler of lumber, a wholesaler of retail goods, a wholesaler to supply other businesses, those were the ones that were starting up, especially in 2010. On this graph, if you see gaps, that means that those industries were not in the highest, the top 10 rather, they were not in the top 10 most frequently occurring SIC codes. So as you can see, over time, from the 2010 vintage to the 2014 vintage, the startups were changing industries. So the industries of startups were changing. Back in 2010, heavily weighted towards restaurants, heavily weighted towards wholesale goods. And then over time, if you look at the 2013 and 2014 vintage, you see a lot more startups in construction, a lot more startups in automotive. So what does that mean? The data is telling us that if you are a risk manager or if you are a target marketer, you need to be aware that startups trend over time, and you need to be on top of that if you want to make a good offer to the right target or if you're managing your portfolio. Where did they start up? We also looked at startups by vintage. As you can see from this graph, they tend to be focused in, of course, the highest populated states, Florida, New York, Texas, etc. But what's interesting about it is that if you look at Florida and Colorado, they had consistent declines in startups over the period started between 2010 and 2014. So you saw that consistent decline in those three states was something of particular interest. So what does that mean? That means if your particular target or if your particular portfolio is focused in those states, you might want to be on top of it to make sure that you're managing that portfolio correctly. But we also looked at declines. We also looked at those businesses that did not make it, those businesses that started up but actually went out of business. In this particular graphic, what we're looking at is those SIC codes that had the highest percentage. These are on the x-axis, these are the top 10 states that had declines or had businesses that went out of business during that period. So for example, in 2010, wholesale goods had the highest spike in businesses that were going out of business. They were not surviving. And then as you can see, if you go towards the 2012, 2013, 2014 vintage, you can start to see that it's shifting into construction. So in 2010, it was wholesale goods. Towards the end of the period, 2013, 2014, for those businesses that started up, they did not make it, tend to be heavily concentrated in construction. And again, you also saw some trends and some shifts in SIC or industry groups that were not there in 2010, but were starting to go out of business in 2013 and 2014. In terms of survival rates, we're frequently asked, how long does a startup, how long can they survive? How long do they survive on average? In this particular graphic, we see that 21% fail their first year, 50% go out in year 5, and by year 15, 75% have already failed. So that means in terms of risk management, we always recommend that you know where your customers are, we know where your small businesses are in that life cycle. In terms of our study, for the million that we actually looked at, we found that 43% of those that started in 2010 did not make it through 2014, 2015. So by 5 years later, 5 years later, 43% did not survive. And then we did that for each year. So for those that started in 2011, this is their survival rate. This is how many did not make it. And if you look at that 2014 vintage, those are the businesses that are walking in right now to get loans and to apply because they just started. Already within 1 year, 14% had not survived. Now, we're going to shift gears and we're going to talk about that 2018% vintage that I spoke about earlier, that special group of entrepreneurs that started their business right after the Great Recession. These next graphs only pertain to that 2010 vintage, and then we followed them through the next 4 years to see how their behavior was changing. In this particular graphic, what we notice is that in year 1, their average credit scores, both the IntelliScore Plus and the Financial Stability Risk Score, were relatively high given the fact that they are just started in business. Because one of the things we hear a lot is, oh, we don't want to lend to the small business startups because they're high risk. And they are high risk, but not as high as you would think. Look at that trend after year 2, 3, and 4. You see where their scores are increasing, and you see their Financial Stability Risk Score. That's a score at Experian that predicts the likelihood that you'd be so severely delinquent that you might not be able to stay in business, begins to stabilize. And that goes to the fact that, hey, we don't want to lend to them because they're higher risk. They are higher risk, but it's not an impossible risk. Why are their scores the way that they are? They're days behind terms. So the days beyond terms is an indicator of how well, on average, that each business is paying their bills. And as you can see, there was a tremendous spike between year 1 and year 2. So as the business is growing, cash flows are getting a little bit strapped. They're looking for credit, and they start to slow down. Well, Pete, you just said in the previous slide that they're certainly lendable, and that's true. They're not perfect, but again, if you look at this, they're only on average between 15 and at almost a peak of 20 days beyond terms, so it's not like they're severely delinquent. There is some, so you need to do some account management, but on average, those startups that survived were doing very well. Thickness of file. Between their first and second year, there was 181% growth in the number of trades. What does that mean? That means they're looking for credit. Those small businesses after their first year, they're looking for credit. They're looking for loans. They're looking to fund their business. And they started out as a relatively thin file in 2010, but by 2011, there were lenders out there that were willing to take a chance on them. And then those lenders continued to do that as other lenders saw that they were getting some funding at the beginning, and then their thickness of file increased steadily. So we know that their scores are stabilizing. We know that their DBT, while increasing, is still within acceptable levels, and we know that they are getting credit, they are growing, the thickness of their file is improving. If you look at their balances, these startups in 2010 exploded after their first year. 268% growth in their balance within 1 year. What does this mean for you as a lender? If you want to get your products and service and get your lending vehicle in front of these small businesses, when do you need to focus on them? in year one, because that's when they're exploding. And that's what this trend shows, that the behavior is exploding imbalances. They're looking for credit. They're looking for growth. That yellow line is an indication of their financial stability risk score, because you might say to yourself, well, I don't want to lend to them because their risk is so high. Not really. Their financial stability risk score actually improved and then started to stabilize towards the end of the period. And then finally, if you look at their credit limits, the recent high credit is the highest amount extended in the last 12 months. That's a surrogate for credit limit. And as you can see, their credit limits are also increasing as well. Balances are increasing. Their recent high credit is, so they're out there looking because their credit limits are increasing. It also means that there are other lenders out there lending to them, which is a good sign if you're on the sideline saying, well, I just don't want to lend to them. There are other lenders out there, and it's hitting after the first year. So if you're targeting a small business, when do you want to target them? That's right, in the first year. So timing is critical because that's when they're growing the most. The yellow line here is an indication of the percentage change between the prior quarter in GDP. So we were just trying to evaluate how come in 2011 and 2012 there seemed to be a little bit of a flattening off in the recent high credit. That's because business owners were adjusting to some additional risk in the economy, because we did see a dip in the GDP over time, especially in those two quarters. But as the economy picked up, look what happened to the demand for credit. Their credit limits were exploding once the economy picked up. So that concludes our presentation, and I hope you found this interesting, and I hope you find that this data will help you make better decisions in the future. Thank you.